Pacific Gas and Electric did not collapse because electricity demand declined. The company, known as PG&E, collapsed because liability outpaced capital resilience. As a regulated utility, revenue was predictable. Infrastructure was extensive. Maintenance costs were substantial. Investment decisions balanced shareholder returns and grid reliability. When catastrophic wildfires were linked to PG&E transmission lines, liabilities surged. Legal claims accumulated. Insurance coverage proved insufficient. Credit ratings fell. Access to capital tightened. Operational obligations remained. On January 29, 2019, PG&E filed for bankruptcy protection. The failure was not revenue volatility. It was concentrated liability, overwhelming a leveraged, regulated capital structure. Pacific Gas and Electric operated as one of the largest regulated electric utilities in the United States. The company provided electricity and natural gas to millions of customers across California. Its service territory covered a large portion of northern and central California. This territory included dense urban regions as well as rural and mountainous areas. Utility infrastructure extended across thousands of miles of transmission lines. Distribution networks connected power plants to homes, businesses, and industrial facilities. Electric utilities operate under a regulated monopoly framework. In this structure, a single provider serves a defined geographic territory. Competition within the territory is limited or prohibited. Regulators set allowable revenue levels for the utility. Rates charged to customers must be approved by state regulators. The regulatory process aims to balance reliability, affordability, and investment needs. Utilities earn returns on approved infrastructure investments. This system provides stable and predictable revenue. Electricity demand tends to remain consistent across economic cycles. Utilities, therefore, operate with relatively stable cash flow profiles. Capital investment is a core requirement of the utility model. Transmission networks require continuous upgrades and maintenance. Distribution infrastructure must be expanded as populations grow. Utilities finance these investments using a mix of debt and equity capital. Regulated returns are intended to support that capital structure. Investors expect consistent dividends from regulated utilities. Utilities, therefore, often maintain significant leverage. Debt financing reduces the cost of capital for infrastructure expansion. However, leverage also increases sensitivity to unexpected financial shocks. Operational risk in utilities is typically associated with reliability failures. Grid outages can produce regulatory penalties or repair costs. Environmental exposure can introduce additional liabilities. In regions with wildfire risk, transmission equipment can become an ignition source. Utilities must manage vegetation and infrastructure maintenance carefully. Risk management, therefore, becomes part of routine grid operations. Regulators monitor compliance with safety and maintenance standards. Financial markets view regulated utilities as relatively stable investments. However, this stability depends on liabilities remaining manageable. When liabilities expand rapidly, the regulated model faces stress. In California, wildfire exposure created a growing operational risk. Transmission networks operated across large forested regions. Equipment failures could produce significant financial consequences. For Pacific Gas and Electric, this exposure gradually became a structural vulnerability. Structural takeaway: regulated revenue stability depends on liabilities remaining contained. Pacific Gas and Electric operated one of the largest electrical infrastructure networks in North America. The system included extensive high-voltage transmission corridors. Transmission lines moved electricity from power generation facilities across long distances. These lines connected hydroelectric plants, natural gas plants, and renewable sources to population centers.
The transmission network extended across mountains, valleys, and forested terrain. Maintaining this infrastructure required continuous inspection and repair. Transmission towers, insulators, and conductors degrade over time. Weather exposure accelerates equipment wear. Wind, heat, and seasonal storms create operational stress on power infrastructure. Vegetation growth near power lines introduces additional operational risk. Trees contacting energized lines can trigger faults or sparks. Utilities, therefore, maintain vegetation management programs. These programs involve trimming or removing trees near transmission corridors. The scale of Pacific Gas and Electric's territory made this task complex. Thousands of miles of transmission lines required monitoring. Distribution infrastructure added further operational complexity. Distribution lines connect substations to neighborhoods and businesses. These lower voltage systems extend through cities, towns, and rural communities. Aging infrastructure increased maintenance requirements across the grid. Some components had been operating for decades. Utilities often schedule replacement through long-term capital programs. However, replacement cycles are influenced by regulatory approval. Major grid investments must be reviewed by state regulators. Rate adjustments require regulatory authorization. This approval process can slow infrastructure upgrades. Utilities must therefore prioritize among competing maintenance projects. Budget constraints influence which assets receive immediate replacement. Older infrastructure may remain in service longer than originally planned. As the grid expanded, operational complexity increased. Monitoring large infrastructure networks requires advanced inspection systems. Utilities deploy aerial inspections, sensors, and field crews. Despite these tools, physical scale remains a major management challenge. Remote transmission corridors are difficult to monitor continuously. Weather events can damage equipment in isolated regions. Repair operations in remote areas take time to coordinate. For Pacific Gas and Electric, infrastructure scale created operational exposure. The larger the network, the greater the potential maintenance burden. Operational reliability depends on consistent infrastructure oversight. When maintenance requirements expand faster than investment capacity, operational risk accumulates. Structural takeaway: large infrastructure networks increase maintenance complexity and exposure to operational risk. Utilities finance infrastructure through long-term capital investment programs. Transmission and distribution networks require continuous upgrades. Substations, transformers, and transmission towers must be replaced periodically. These investments are funded through a combination of debt and equity. Regulated utilities typically operate with significant leverage. Debt financing lowers the cost of funding large infrastructure systems. Investors accept moderate risk because revenue is regulated. Regulatory frameworks allow utilities to recover approved investments through customer rates. However, this recovery occurs over long time horizons. Infrastructure investments are amortized over decades. Utilities must therefore balance investment pace with regulatory approval cycles. If investment rises too quickly, rate increases may face resistance. Regulators must consider affordability for customers. Utilities therefore manage capital allocation carefully. Executives prioritize projects based on regulatory approval and system reliability. Grid modernization programs compete with routine maintenance needs. Large infrastructure systems rarely receive full replacement simultaneously. Instead, utilities stagger upgrades across the network. This approach spreads capital requirements over time. However, it also leaves portions of the grid operating with aging equipment. Deferred upgrades can increase long-term operational exposure. Maintenance budgets must therefore remain consistent. Unexpected operational risks complicate capital planning. Wildfire exposure in California introduced additional infrastructure risk. Transmission lines crossing forested areas required enhanced safety programs. Utilities began expanding inspection and vegetation management initiatives. These programs increased operating costs. Capital spending also rose as utilities attempted to strengthen transmission systems. Financial markets continued viewing regulated utilities as stable investments. However, rising infrastructure costs placed pressure on financial planning. Debt levels increased as capital programs expanded. Credit ratings agencies monitor leverage and risk exposure closely. When operational risks increase, financing conditions can change. Utilities depend on stable access to debt markets. If lenders perceive rising risk, borrowing costs increase. For Pacific Gas and Electric, capital allocation decisions occurred alongside rising environmental exposure. Infrastructure investment constraints gradually intersected with wildfire liability risk. Structural takeaway capital allocation decisions shape how infrastructure risk accumulates over time. California contains large areas of forested and mountainous terrain. Many communities are located within regions classified as high wildfire risk zones. Electric transmission networks cross these regions to deliver power. Transmission towers and conductors often extend through remote landscapes. Dry vegetation and seasonal winds increase wildfire vulnerability. During hot months, vegetation becomes highly combustible. Wind events can push tree branches toward energized lines. Electrical faults can generate sparks or falling conductors. These conditions create ignition risk near transmission infrastructure. Utilities, therefore, manage vegetation along transmission corridors. Tree trimming and vegetation removal reduce potential contact with power lines. However, maintaining clearance across large territories is operationally demanding. Inspection crews monitor thousands of miles of transmission routes. Utilities use helicopters, drones, and ground patrols to identify hazards. Despite monitoring systems, infrastructure exposure remains substantial. Extreme wind events can stress power infrastructure unexpectedly. Equipment failures under these conditions can trigger ignition events. California experienced increasingly severe wildfire seasons during the 2010s. Long drought periods intensified vegetation dryness across the state. Climate patterns increased the frequency of high wind conditions. Wildfires became more destructive across Northern California. Transmission infrastructure operated directly within these high-risk environments. When ignition occurs near power infrastructure, utilities can face liability claims. California law historically applied strict liability principles in some wildfire cases. Utilities could be held financially responsible if equipment caused ignition, even when equipment operated within regulatory standards. Legal exposure, therefore, expanded beyond operational fault. Wildfires can produce extensive property damage. Insurance claims and legal settlements can reach billions of dollars. Utilities must therefore manage both operational and legal risk. Transmission exposure across wildfire regions created a growing liability channel. Each ignition event introduced potential financial consequences. As wildfire severity increased, financial exposure also expanded. Investors and regulators began monitoring wildfire risk more closely. Operational reliability alone no longer defined infrastructure risk. Liability exposure became a parallel financial threat. For Pacific Gas and Electric, transmission exposure intersected with extreme environmental conditions. Wildfire risk therefore became a structural operational challenge. Structural takeaway: environmental exposure can transform infrastructure risk into financial liability. Wildfire seasons in California intensified during the late 2010s. Several large fires were linked to electrical infrastructure failures. Investigations examined whether transmission equipment initiated ignition. When utilities are connected to wildfire ignition, liability exposure can escalate rapidly. Legal claims accumulate from property damage and infrastructure loss. Residential structures, commercial buildings, and public infrastructure can be affected. Wildfires may destroy thousands of structures within a single event. Insurance companies file recovery claims against responsible parties. Local governments may pursue additional legal action. Victims of property loss also pursue civil litigation. Each claim adds to potential financial exposure. Legal liability in wildfire cases can reach billions of dollars. For utilities operating in high-risk regions, this creates concentrated financial risk. Pacific Gas and Electric faced multiple investigations following major wildfire events. Regulators and investigators examined whether transmission equipment played a role. When equipment faults are linked to ignition, legal responsibility can follow. Financial exposure therefore expands beyond operational repair costs. Utilities must consider settlement negotiations with claimants. Large wildfire events may produce overlapping legal proceedings. Courts evaluate responsibility, damages, and settlement structures. Insurance policies provide partial financial protection. However, insurance coverage typically has defined limits. If liabilities exceed insurance coverage, companies must absorb remaining losses. For Pacific Gas and Electric, wildfire exposure shifted from operational risk to financial crisis. Structural takeaway: concentrated legal liability can overwhelm otherwise stable regulated revenue systems.
Insurance coverage is a standard risk management tool for large utilities. Utilities purchase insurance policies to protect against operational liabilities. These policies typically cover equipment failures, accidents, and third-party damages. However, insurance policies include defined coverage limits. Coverage limits cap the maximum payout insurers will provide. If liabilities exceed those limits, the company must absorb the remaining cost. Wildfire liabilities in California began exceeding traditional insurance coverage levels. Large fires produced claims far beyond standard utility insurance structures. For Pacific Gas and Electric, liability estimates expanded rapidly. Insurance protection covered only a portion of potential exposure. The remaining financial obligations fell directly onto the company's balance sheet. Financial analysts began reassessing the company's credit profile. Credit rating agencies monitor risk exposure and leverage levels. When liability exposure increases, rating agencies may downgrade credit ratings. Credit downgrades signal rising financial risk to lenders and investors. Borrowing costs increase after a downgrade. Utilities depend heavily on debt markets to finance infrastructure investment. When financing conditions deteriorate, capital planning becomes more difficult. Credit downgrades can also trigger contractual restrictions. Certain financing agreements include provisions tied to credit ratings. If ratings fall below thresholds, additional financial pressure may occur. Market confidence becomes fragile under these conditions. Investors monitor whether liabilities can be contained. For Pacific Gas and Electric, insurance limits and credit downgrades intensified financial stress. The company faced rising costs while liability uncertainty remained unresolved. Structural takeaway, limited insurance coverage, and credit downgrades can amplify liability-driven financial crises. Utilities rely heavily on access to capital markets. Debt financing supports infrastructure maintenance and expansion. Transmission upgrades require continuous capital investment. Distribution networks also require ongoing funding. Utilities, therefore, maintain active relationships with bond investors. Stable credit ratings support consistent access to financing. When financial risk increases, investor confidence can weaken. Bond markets respond quickly to perceived credit deterioration. Higher perceived risk leads to rising borrowing costs. Investors demand greater yields to hold utility debt. For Pacific Gas and Electric,
Wildfire liabilities altered risk perceptions. Legal exposure created uncertainty around future financial obligations. Credit rating downgrades signaled growing financial instability. Debt investors began reassessing the company's creditworthiness. Bond spreads widened as risk premiums increased. Access to new financing became more difficult. Utilities cannot easily pause infrastructure investment. Transmission and distribution systems must remain operational. Maintenance obligations continue regardless of financial conditions. Without access to capital markets, utilities face liquidity pressure. Liquidity refers to the ability to meet short-term obligations. Operational expenses must be paid regularly. Employee payroll and contractor payments continue. Equipment maintenance and inspections must proceed. Regulatory compliance requires continued investment. As financing conditions deteriorated, financial flexibility narrowed. Investors questioned whether liabilities could exceed available resources. Uncertainty about total wildfire exposure intensified these concerns. Bond markets reacted by limiting new lending. Equity investors also reassessed the company's financial outlook. Lower equity valuation restricted the ability to raise new capital. Utilities rarely face sudden capital market isolation. However, concentrated liabilities can trigger rapid investor withdrawal. For Pacific Gas and Electric, this dynamic became visible. Financial obligations continued while financing options contracted. Capital market access became a critical constraint. Operational systems still required funding to maintain grid stability. Structural takeaway: when capital markets withdraw support, infrastructure-dependent companies face severe financial pressure.
Electric utilities provide essential services to the public. Electricity supply must remain continuous regardless of financial stress. Grid operations cannot pause during corporate financial crises. Transmission systems must remain energized and monitored. Distribution networks must continue delivering power to customers. Utilities therefore face operational obligations even during financial instability. Pacific Gas and Electric continued operating its grid during the liability crisis. Field crews maintained transmission infrastructure across the service territory. Substations remained active and distribution systems continued operating. Customers still required electricity and natural gas services. Regulatory oversight required the utility to maintain operational reliability. Public safety responsibilities remained unchanged. Maintenance programs continued despite financial uncertainty. Vegetation management operations still required field personnel and equipment. Inspection programs continued along transmission corridors. Operational continuity required ongoing funding. Payroll obligations continued for thousands of employees. Contractors supporting infrastructure maintenance remained active. Fuel procurement for power generation continued. Electricity procurement contracts remained in effect. Utilities must also maintain regulatory compliance during financial distress. Safety inspections and reporting requirements continue. Regulators monitor operational performance even during restructuring periods. Failure to maintain grid reliability could introduce additional penalties. Operational stability therefore became a priority during the financial crisis. Management faced the challenge of balancing liquidity constraints with grid operations. Cash management became critical to maintain daily operations. Short-term financing arrangements supported ongoing operational costs. Regulators coordinated with the company to maintain service continuity. Public confidence in grid reliability remained important. Electricity supply disruptions could create broader economic consequences. Utilities operate as critical infrastructure providers. This status requires operational continuity even when financial conditions deteriorate. For Pacific Gas and Electric,
Operational obligations persisted despite mounting liabilities. The company continued maintaining infrastructure across its service territory. However, financial uncertainty remained unresolved. Legal claims and credit pressure continued expanding. Operational stability alone could not resolve structural financial exposure. Structural takeaway. Essential infrastructure companies must maintain operations even while financial stability deteriorates. Wildfire liabilities continued expanding during the late 2010s. Investigations linked multiple major fires to transmission equipment. Legal claims accumulated across several wildfire events. Financial exposure grew beyond the company's insurance protection. Credit rating downgrades intensified pressure on financing conditions. Bond investors demanded higher yields to compensate for rising risk. Access to capital markets narrowed as uncertainty increased. Liquidity management became increasingly difficult. Pacific Gas and Electric faced billions of dollars in potential claims. Legal proceedings suggested liabilities could exceed available financial resources. Financial analysts began modeling bankruptcy scenarios. Regulators monitored the company's financial stability closely. Utility operations still required continuous funding. Infrastructure maintenance obligations remained unchanged. Debt maturities approached while financing options declined. Credit markets signaled diminishing confidence in the company's solvency. Management evaluated restructuring options to stabilize finances. Bankruptcy protection became a potential mechanism for managing liabilities. Chapter 11 allows companies to reorganize under court supervision. This process enables companies to negotiate settlements with creditors. Operations can continue while restructuring occurs. For regulated utilities, this process must also coordinate with regulators. On January 29, 2019, the company filed for Chapter 11 protection. The filing represented one of the largest utility bankruptcies in United States history. Legal claims related to wildfire damages formed the core financial issue. Bankruptcy created a structured forum for resolving those liabilities. Courts began overseeing negotiations among creditors and claimants. Insurance coverage and company assets formed part of settlement discussions. Regulators sought to ensure continued electricity service. Operational continuity remained a priority during restructuring. Financial markets reacted to the bankruptcy announcement. Equity values reflected the scale of expected losses. Credit markets reassessed the company's long-term financial structure. Settlement negotiations began with wildfire victims and insurers. Bankruptcy protection allowed liabilities to be consolidated into a restructuring process. Utilities rarely enter bankruptcy due to revenue collapse. In this case, operational revenue remained relatively stable. The primary pressure came from concentrated liability exposure. Financial restructuring therefore focused on resolving legal obligations. Structural takeaway. Bankruptcy can become a mechanism for resolving liabilities that exceed a company's financial capacity.
The bankruptcy process initiated a complex financial restructuring. Courts supervised negotiations among creditors, insurers, and wildfire claimants. Settlement agreements formed a central component of the restructuring plan. Wildfire victims required compensation for property damage and losses. Large settlement funds were established through the bankruptcy process. Equity contributions and financial restructuring supported these settlements. Creditors negotiated adjustments to existing debt obligations. New financing structures were introduced to stabilize the company. Regulatory approval remained necessary throughout the restructuring process. California regulators required assurances regarding grid reliability. Operational oversight continued during the bankruptcy proceedings. Infrastructure maintenance and safety investments remained essential. Transmission systems still required upgrades and inspections. Utilities cannot suspend long-term infrastructure investment.
The restructuring, therefore, aimed to preserve operational capability. Financial settlements addressed accumulated wildfire liabilities. Insurance proceeds contributed to portions of the compensation funds. New equity issuance supported financial stabilization. Debt restructuring adjusted the company's capital structure. The company also committed to enhanced safety and vegetation programs. Operational reforms aimed to reduce future wildfire risk. Improved inspection procedures were introduced across transmission corridors. Infrastructure monitoring programs expanded significantly. These measures aimed to restore confidence among regulators and investors. In 2020, the company emerged from bankruptcy protection. The restructuring allowed the utility to continue operating its infrastructure network. Electricity and natural gas service continued across the territory. Financial markets reassessed the company's long-term stability. Regulators maintained ongoing oversight of safety and maintenance programs. The case illustrated how environmental risk can interact with financial structure. Regulated utilities are often viewed as stable investments. However, stability depends on the relationship between liability and capital resilience. Large infrastructure systems can carry hidden exposure to external risks. Environmental conditions can convert operational incidents into financial crises. Legal frameworks may expand corporate liability beyond traditional expectations. Capital markets respond quickly when liabilities exceed financial capacity. The Pacific Gas and Electric case demonstrates a structural vulnerability in regulated utilities. Regulated revenue stability does not eliminate liability concentration risk. Corporate collapse can occur when operational exposure overwhelms financial resilience. Structural takeaway: regulated revenue stability does not eliminate liability concentration risk.